everyone. We are back with another top 5, Michael Houston and Jamie Olson. And today we're going to be talking about the top 5 money moves when you're just starting out.
Let's do it.
What does that mean? Just starting out? What age do you have to be to just start out?
Good question, because, we're just talking about starting out, financially investing. You could be 40, you could be 23, you could be 60. The key is we start where we start. And if you don't have any investments, that's where you start. You could be any age.
Non-aged bias here. If you're just starting out, we don't care how
Never too late.
It's never too late, and these 5 will work for you.
Yeah, the key is to get started.
Get started. Okay, number 5, without further ado, is budget. What do we have to say about that, Michael?
Tell your money where to go, or you wonder where it went, right? And it's one of those things where, without it, the rest of what we're going to talk about is pretty meaningless. And so Jamie and I have a couple apps. You like Ramsey EveryDollar app?
Yep, EveryDollar app is the budgeting app I've used in the past.
It's cool. We've talked about this. You have to manually allocate every dollar. And so there's more work involved that could be good to get started. I use personally an app called Copilot, which, I plug in my accounts, it pulls the information. I can, break down my spending by category. How much did I spend at the restaurants last month? And that's how I track it. But the key is that you're making conscious decisions on what to do with your money.
Yep, and it doesn't need a fancy app. If you want to do an Excel spreadsheet or the good old pen and paper, that's what my husband Justin used for years and years, and it worked great for our family. Do it. The key is you just have to budget. You need to know where your money's going. All right, number 4, an emergency fund. Have one. What does that mean, Michael?
Rainy day fund. Grandma was right. And when we, set aside an emergency fund, the rule of thumb in our industry is 3 to 6 months worth of your living expenses. So you look at your budget and you figure out, okay, this is what it costs per month to live. And it's important to consider that, there's some expenses that don't happen every month, but, will happen recurring, like maybe you pay your auto insurance once or, semi-annually. And so you average that out over the month. Minimum is 3 months, 6 months. People that are trying to decide which is right for me. If you're an individual or, you're a married couple and maybe there's not the job stability that you want, you might want to lean towards the 6-month side of it. If you're married, you both have very stable incomes, 3 months, if that's your comfort level. If there's a dispute between a married couple, my recommendation is go with the more conservative, the larger amount.
Agreed.
The two. This is not an area that you want to have a big debate or lose any sleep over. So just go with the more conservative so that everyone can sleep well at night.
All right. So Michael, I've worked hard. I have saved my 6 months of expenses, or 3 months if you want to choose 3 months, anywhere between that 3 to 6 month window. I've saved 6 months because we're a little bit more conservative. Where do I save it? Do I just keep it in a penny jar or under my mattress? Where do I save my rainy day fund?
Well, this has changed a lot over the last 15 years because we went through a period where you're getting 0% interest rates for a long time. Now you're at least getting some. I think the key is making sure that you're in a highly liquid, FDIC-insured, don't get fancy, checking savings account. Avoid accounts that are paying you 0. Surprisingly come across a lot of accounts that, don't pay any interest. You can get some interest now, and there's any number of different banks that you can utilize for this. 3.5% is about the going rate today. But, making sure that you're safe, liquid, and getting some interest as much as you're able to, that's the smart thing to do here. What you don't want to do is say, well, I'm going to try to, invest this for more growth. This is an emergency fund. And the problem is if you try to invest for more growth, sometimes the emergency happens when the economy is doing poorly, and that's when you need to tap it. And if you're in something like stocks with your emergency fund, bad times, you might lose your job and then you're selling your investments when they're low. That's not the emergency fund's job. This is a rainy day fund to act as a buffer in between you and the unexpected things that can happen in life.
Well said. All right, that takes us to number 3, the third top 5 money move when you're just getting started. Oof, this is my favorite. Wipe out debt. Michael, how do we do that?
Wiping out debt is your favorite?
This is my favorite. I want to be on the Dave Ramsey show and I want to scream, I'm debt free.
When you're building from a strong foundation without having debt, you're going to be a better investor and you're going to grow your assets in a way that you can sleep well at night. And this comes from someone that has a consumer lending background. Out of college, I spent the first 5 years of my career managing a sales team. We did, auto loans, credit cards, installment loans, home mortgage refinances, right into the teeth of the financial crisis. And when you carry debt, this can be both an inhibitor on your ability to take career risk. When things go wrong, you might have to tap your investments. It really is, just an anchor to your financial situation. Moreover, one of the most underappreciated things about consumer debt, when I say consumer debt, this is borrowing to buy things or stuff that goes down in value, right, is that you will spend more on that item if you're borrowing than if you pay cash. Harvard did a study even at a vending machine, and vending machines went from cash to credit cards years ago. People spent twice as much on average using a credit card versus cash. And there's many studies that illustrate this. But if you borrow to buy something, you'll spend more money. So excluding even the interest part of this, the debt can cause cash flow to go to places that it might not otherwise. So we're not fans of debt. Consumer debt should be avoided and paid off before investing.
And better yet, just don't even get into debt in the first place. So if you're just starting out and you don't even have a credit card, there's a lot of science behind not even opening one.
Yeah, and if you are in debt and this is a situation you're trying to get out of, Dave Ramsey recommends the snowball method. We're big fans of that.
Yeah.
There's been studies around it that prove that this is better than other methods. Other methods would include the avalanche method. There's all these fun names. But basically the way that it works is you list your debts from smallest to largest and you start with the smallest debt. Pay that off. You snowball that amount you were paying on the smallest debt on the next smallest debt, so on and so forth until they're all paid off. The avalanche method is you start with the highest interest. The problem with that is you're not getting the small wins, and psychologically we know that once you're knocking out those small debts, you get some momentum, and people end up having better outcomes because of that. So we recommend snowball method over the avalanche or alternative methods. Don't overthink it, just do it.
Yeah, biggest success rate there. All right, this brings us to number 2, insurance. And most people don't think about this. So what do we have to say about insurance? What kind of insurance are we talking about?
Oh boy, this is a very important one. Property and casualty insurance. Obviously, people know that they need to have car insurance if they're driving, a car is the law if you have a home, but making sure that you have the appropriate amount of insurance. Do you need an umbrella policy? And then moreover, like if there's someone else that depends on your income to be able to make ends meet, pay the bills, you really need to consider term life insurance. The way term life insurance works is that, as the name term implies, is for a pre-specified term. Okay, so it could be 10, 20 years. But until your assets are to a level that, God forbid, my wife, she stays at home because she works there. If I pass away, my income goes away, I'm not going to be able to build the assets. She won't be able to build the assets needed to support the family. That term insurance fills the gap. The other insurance that's important to consider that I would throw in here would be disability.
Yes.
You're 6 to 7 times, I think, more likely to become disabled and not able to work than to die. Personally, I have multiple disability policies. Like if I'm disabled, to buy out my business partner or to generate monthly income for my spouse. These are all very critical things to consider, that even if you had the best investment plan, unfortunately, things could go awry and you need to have insurance to help cover that.
And this can be one of the trickiest things to field if you are a young person who maybe just graduated college, because your parents have always covered you for insurance, right? So this is all a little bit Greek to you. If you do have any questions, you can always come to Michael or I. We are not insurance agents. We are fiduciaries. So we will just do a review of your plan and see, do you have the proper coverage? Are you properly covered? Do you need more? Do you need less? Things like that. And we will guide you on the right track. So never be ashamed to ask questions.
Yeah.
Okay, this brings us to number 1. The number 1 top money move when you're just getting started is to invest. How much should we invest? Do we automate investments? Where are we investing? Why are we investing? Give us some tips, Michael.
Investing is not rocket science, and there's lots of good ways to access high quality investments today at a very low cost. And so, the key is automating is one of the things you mentioned.
What do we mean?
So not thinking about it. If you have to write a check and make a deposit or transfer money manually every month to make the investment, there's going to be times that you're not likely to do that.
That money just won't be there at the end of the month.
The most common way people do this is a payroll withholding out of their paycheck. They put it into their 401k. You definitely don't want to forego that match that you're going to get from a company. If you get a match, that's the first place that I would recommend starting. But, bigger picture, the thing that you want to target is 10 to 15% of your income going in investments every year, every paycheck, right? And, I think a lot of people get hung up on, what's the best investment? It's like, you're much better off investing an extra 5% of your paycheck than finding the single best investment. Right? An indexed fund or something in your 401k is totally fine to get started. Don't overthink it. Just do it, automate it, get it going, put compounding to work for you. It's one of the greatest forces in the universe. And, over time, small amounts of contributions can make a big difference. And whether you're 40 years old or 20 years old, the sooner you start compounding, the better off you're going to be.
All right. I'm going to do a quick case scenario, Michael. So I'm a 21-year-old, okay, just graduated college. I've got my very first job. Okay. they're talking about something called a 401k, and they're saying things about it matches. It looks like, oh my gosh, I have a 5% match. That's pretty good. So I think I'll put in 5% because Michael and Jamie said to at least put in up to the match. So they're going to match 5%. So I'm going to put in 5%. That equals 10%.
Yeah.
Now, when you say, Michael, that we want to invest 10 to 15% of our income, have I hit that marker by investing 10% because the employee's matching 5%, I'm putting in 5%? Or do I need to put in 10% of my income and then they match 5%? What do you recommend?
I would say if you're at least doing the 5 and you're getting the 5% match, you're at 10% of your income going into investments. It's a fine place to start. What I would say is that, if you're able to do 10 to 15% of your own income and then treat the match is gravy, so to speak, you're obviously going to be better off. And the problem is there's kind of this tendency to keep up with the Joneses. And if you're putting a percentage of your money into it, as your income goes up, so does your contributions. And so if you can automate it and, lean towards at least 10% of your own income, that's a best practice. But at the very minimum, getting it to just 10% with the match, you could start a lot worse places than that. What do you think about that approach?
I agree. And I would say too, second case scenario, Michael, if for all of our people who are maybe middle-aged just starting out, let's say I'm 50, I've just started this new job, I'm starting my very first 401k. I understand a little bit more of investments at this point, but again, I'm just starting out. They have a 5% match. What would you recommend I contribute to my 401k?
You probably want to contribute more. If you're just getting started at age 40 versus 20, your money doesn't have a long enough time to compound. And so to make up the difference, you've got to have a higher savings rate. Again, this is not rocket science, but you have to make it a priority. Financial independence, peace of mind that comes with that, knowing that you're on the right track. And working with a financial advisor, I think is, we could easily put in this top 5. But for someone just getting started, if you can do these basic things, you're on the right track and stick with it over time, you're going to be on pace to do good things financially and feel better about your life. And I think that that's really going to bring you a lot of peace.
Yep. The 2 keys to these top 5s are start wherever you are. We don't care how young you are or how old you are. It's not too late to start and be consistent. That's it. Those are the 2 key takeaways. So to wrap up our top 5 money moves when you're just getting started, as a reminder, number 5 was budget. Do a budget. Number 4, emergency fund. Build up your savings. Number 3, wipe out your consumer debt. Number 2, insurance. Have it. And number 1, invest wisely. Until next time, thank you for joining us.